Anyway, I'm Jack Conlon. That's about all the introduction we need. I'm an actuary and I live in the CCRC. This is A.B. Pell, who's known to many of you probably already. And I'm going to be running on A.B.'s computer, so let's hope this works as we expect. First, we start with what do providers want, and the context is the financial management of the CCRC. And providers want financial success.
Thank you.
They hope for a quick fill-up and continued high occupancy thereafter. They want residents who are able to afford to live in the facility and who are happy about their choice to live there. What do residents want? Residents want a lifestyle and security. Security involves financial security, financial certainty. No one wants to be a ward of the state. And this was evident in Ken Dykewald's talk this morning, which was, I thought, quite provocative, although I think you're going to find that he might have benefited from talking with some actuaries, but anyway, that's just a personal aside. But security beyond mere financial security involves physical security and assurance that services will be there when and as needed. And today's CCRCs do a good job of providing physical security. Most of what is involved is well understood. Financial security is more elusive. So let's look at some of the challenges to see what it would take to bring financial security up to the same level as the physical security that CCRCs now provide. And just yesterday, I learned of the bankruptcy of the village at Penn State. I don't know whether you've all gotten that on your news alerts. This is just the latest in a series of recent CCRC financial failures. And according to an executive for the bankrupt entity, those feeling the most pain are the bondholders. They are owed a cumulative $29 million. The executive said, quote, "The bondholders are understanding of the process. It's just one of those things that happens with the industry, as though it's inevitable that in the CCRC industry, bankruptcies just happen along the way. Clearly, there's a need for more astute business judgment and analysis in the formation and operation of CCRCs." There are many financial experts serving the CCRC industry. Even the architectural firm Perkins Eastman has a financial aspect included in its software. You can do projections using the Perkins Eastman software package. And more recently, economists have become more interested in aging because of the growing political clamor for insurance programs to help with long-term care costs. And you heard Ken Dykewald allude to some of that economic research this morning. But two professions stand out for addressing the financial security that residents crave and the financial challenges that providers face. Accountants have traditionally been the central resource for CCRC managers. Actuaries are highly trained, select professionals versed in the mathematics of finance and human contingencies. Actuaries are able to model the challenges that people face as they age, the very challenges that we saw Ken Dykewald talking about this morning, the challenges that might enable us to help workers to provide for their own old age during their productive years, something that has eluded us. Residents want assurance that the CCRC will continue for the rest of their lives and that any refund obligations for their heirs will be paid promptly and in full. Providers want financial policies that facilitate the development of new CCRCs and that allow sufficient margins for fair pay for staff and executives. And you are all prospective residents, except, of course, for those few of us in the room who are already residents. So we're all concerned about this. So let's pause for a moment to talk about actuaries, since there are two of us here today, and that's probably a greater concentration of actuaries than most people can stand in a lifetime. A qualified actuary can help to ensure that calculated liabilities make full and sufficient provision for all contractual and related commitment obligations for any CCRC that makes lifetime commitments that involve guarantees of availability of services for contingencies of human aging. This does not mean that entrance fees can't be invested in buildings. It does not mean that they need to be escrowed, as some have suggested. But there is a need for liquidity. You need liquidity to meet everyday costs, food, payroll, normal costs of operation, and you need liquidity to meet contingent costs, refunds, increased utilization of skilled nursing facilities, etc. And there are mechanisms to meet liquidity needs: cash management, letters of credit, reinsurance. And actuaries can help you to project these cash needs to optimize the financial workings of a CCRC. Also, actuaries can help you to meet market demand, and this is where the handout you've got comes in, because all of those contract variations shown on the handout are mathematically related to each other. So there's no reason why a provider couldn't offer options to allow a prospective resident to tailor the choices they're making in terms of the financial aspects of the contract to what their particular needs are for peace of mind or financial security. You can offer these options, and you can wrap long-term care. It can all be put together. And for those providers who fear the risk involved in higher acuity contracts, if you will, I'm not sure what the right word is, but those who are afraid of a type A contract, there's reinsurance available or can be made available to provide for that risk. So this is something that could help marketing, and many providers do offer these options. The CCRC where I live has a Type C contract. That means that my wife and I have had to set aside substantial personal resources, roughly $500,000 apiece for my wife and me, so a total of $1 million, as a reserve against the possibility that we may eventually need nursing care or other assistance. That's not included in our contract. And we can't reserve for that at the average amount. We have to reserve at the worst case amount because we don't know what's going to be our situation. Recently, a friend of ours who just turned 70 and is feeling her age decided to leave our CCRC, taking a loss on her entrance fee to do so, to move to a competitive facility that offers a Type A contract and better financial security overall. So this is a real factor in the marketplace, and it can affect how competitive you are. Actuaries also can help refine the mathematics of operating the CCRC, and I want to go into this a little bit because this is something that seems to be misunderstood. We don't have some standard set of assumptions that we just roll out for every case. We try to map the assumptions that we use to the experience that we expect for the particular CCRC that's being looked at. And over time, as we gain experience, we can modify those assumptions so that the modeling becomes a better representation and a better guide for management in how to meet the needs that are required. You can't manage what you don't measure, and actuaries are very versed at doing exactly that. So actuaries can be valuable members of your business team, whether you offer a Type A contract or if you join the trend to Type C. And even with Type C, you still have to anticipate demand for services so that you are prepared to meet that demand when it comes. That brings us to That brings us to current concerns among residents, and more importantly for you, among prospective residents. First, we found, and the we here is the National Continuing Care Residents Association that I've been involved with, we found that most residents are simply not interested in financial and contract matters. They trust you as providers to have their interests at heart, and they came to your community to retire. These complacent residents can have their faith in you shaken when they hear of bankruptcies or other financial failures, and there's a growing number of those. But what might interest residents if they thought about it? Now, this is a little theoretical. We started theoretically, talking among ourselves, but just saying what bothers us. So NACRA's focus was on trying to address these things. The first thing we came up with was the security of resident investments in their entrance fees and stewardship for their use. People pay entrance fees expecting that those funds will be used to meet their needs as they age, so they won't become a burden for their children or wards of the state. The second area is the area of accounting integrity, and Jim may have something to say about this. The accounting profession has moved from a profession that used to focus on principles like matching and consistency to a rules-based system. So today there are accounting standards codifications, which is the name that the Financial Accounting Standards Board uses for accounting rules. And those rules are different for CCRCs than for other industries. So a transaction that might be treated one way in one industry is treated differently in the CCRC industry. Also, the effect of the life expectancy standard, which is commonly used, is to fail to match revenues to the costs which those revenues are intended to finance. And so that creates a challenge. And this gives you an idea of how it might work out in a very simple case. If you consider a case in which all that an entrance fee did was to pay a level amount per month for the cost of running the community. In other words, it was basically a life annuity. Then the matching principle would have the blue line here. But the current accounting standards codification for CCRCs front ends those earnings so that it looks like it's doing better in the early years, and then a few years in, it looks like you have to make up. So you start increasing rates for residents, and then the thing comes back out of the hole, and after a while, you're okay. Incidentally, this was pointed out by A.B. and Howard Winklevoss in a book they published in 1984, and it's still out there, so you may have something more to say about that. The next thing that we thought would be of interest is equity among and between cohorts of residents. People who transfer apartments, their spouse dies, they want to downsize to a smaller apartment. Not all CCRCs have equitable rules for determining the financial kicker that has to be paid in that circumstance. And also, no generation of residents should be required to subsidize another generation of residents. Those are equity considerations. And finally, we focused on contractual integrity so that contracts can be readily understood and that they are an instrument for fulfillment of commitments rather than just a document crafted to allow providers to defend themselves against recalcitrant residents. But that's all theory, and we don't want to be theoreticians. So, in fact, our focus really is, our hope is, that we can persuade providers to change the thinking from doing things for residents to doing things with residents. And I know that many providers already do that, but that's something that we need to continually work toward. Anyway, the National Continuing Care Residents Association met, I guess it was a week ago, 10 days ago, in Virginia, and we went through a strategic planning exercise with a facilitator to see what was on the minds of that representative groups of residents. And I, for one, was surprised by the results. The top concern among that group of residents was the shift of risk from providers to residents, the move from Type A contracts to Type C. What happens is that people move into a CCRC, imagining that they know what it is, trusting that, gosh, it's sponsored by the Presbyterians or the Episcopalians or B'nai B'rith, and so we understand these are trustworthy people, and they get in there thinking they're going to have peace of mind, and now they find they face this cost exposure, and they worry that they may run out of their money or that they may become a burden on their children or on the state. And that is something that Ken Dykewald alluded to today, and it popped up among this resident group. The second is they wanted transparency, and you probably heard about this. They'd like to have resident representatives on boards of directors. Having been on the board, I think they exaggerate the influence that boards have in the management of things, but this is just saying what they wanted. They're worried about increasing operating costs and how that might lead to increasing monthly fees, and they may not have the resources to meet that. They worried about the increase in the number of fees for service. Now, I think that ties in probably with number one, but since it was a separate item in this summary, I've kept it here for the sake of integrity. They're worried about the prospect of higher health care costs. There's a big fear among the elderly that the Affordable Care Act is going to result in higher costs for the elderly. And this is, I was surprised how widespread this is. People aren't talking about it. It's not dinner table conversation. But when you run this kind of an exercise, that came out. Yeah. They noticed the lowering of health standards for entry. People coming into independent living, and you say, gosh, aren't they going to this skilled nursing facility, or why this or why that? And we understand about the Americans with Disabilities Act and the Fair Housing Law, but still, this is something that was on the minds of the residents there. And they're concerned about the challenge of occupancy in a down real estate market. I guess we all understand that one. And finally, they had a perception that the newer prospective residents coming forward are making deeper inquiries, more competitive studies, asking more questions, probing things. And so for our National Continuing Care Residents Association, we turn that around, that we have an obligation, therefore, to provide materials that can help prospective residents make better choices in choosing where to live. Where does that leave us on our core concern here? Financing CCRC residents, before I turn this over to AV. My experience is that money is not a problem when the product is matched to the market. An attractive product in an attractive location sells itself. Our community, which is on the beach between the railroad track and a wonderful village, is full. I don't think it's ever going to have a major vacancy problem. So this creates a challenge for us that we can work together to meet as providers and as residents. If we get the product right, I don't think financing will be a problem. Now, that brings me to A.V. Powell, and this is the book I mentioned before. This book has been around since 1984, and I'm always surprised when I meet providers who are not aware of it. And there's a little bit of a story. A.V.'s going to introduce himself, so I'll just talk about his co-author here, Howard Winklevoss. Howard Winklevoss has two sons, Tyler and Cameron. And Tyler and Cameron, are they twins? They're twins. So they went off to Harvard, and they thought they had a bright idea, but there's another fella who may or may not have had the same idea at the same time, but he was effective in bringing it about. But these guys were not happy, so they brought a lawsuit, and I think they will be independently wealthy for the rest of their lives, because the Tyler and Cameron Winklevoss are the youngsters who sued Mark Zuckerberg over the Facebook thing. And with that, I'll turn it over to A.V. We need to remember.
Thank you, Jack. All right. Thank you all for coming out today. We have a few more minutes. I have about 30 slides to go through, so I will try to do that in, say, 5 minutes. So keep up. No, just kidding. How many folks here are actually residents of the CCRC? Oh, about half. Great, great. My focus today is really toward residents of CCRCs or prospective residents. Normally, we work with management and the board, but my theme is to talk about what should a resident living in a CCRC or planning to live in a CCRC should be asking about the financial security of that organization. And to try to do that in layman's terms without getting overly technical. So bear with me as I go through these slides and feel free to interrupt and ask questions. Very briefly, I'll tell you who I am, and then I'm going to go over 10 questions or issues that you might ask in regard to your concerns about the financial situation of the CCRC you're living in. Just very quickly, we've been in the business of consulting with CCRC since 1979. I've actually had 34 years in this industry. I think I was probably spoken at the Leading Age Conference over 25 times, going back to days when it was AHA and then ASA and so forth. In fact, when I was a graduate student at the Wharton School working on a PhD, and AHA was involved in its advisory council with us writing a book, and also encouraged many facilities to work with us on that. I think we published the first national directory of CCRCs, sort of keying off of what Kendall Process done back in the mid-70s. We work regularly with over 125 communities each year, and that gives us a perspective, and these are across the country, in comparing what results are. Very few communities do, of the 2,000 CCRCs, actively engage actuarial analysis. And I'm not here to promote actuarial analysis. It's simply a tool that folks can use to quantify answers to their questions and measure risk. You can operate successfully with or without that tool. So if that's the case, why would one want to look at an actuary and ask them to help them with their work? It's a question of risk. Some people like trying to make informed decisions. Other folks try to run things and see their pants. And that's not meant to disparage any providers here, but they're sort of two extremes. Basically, what actuarial analysis can do is help you make a more informed decision about your solvency and pricing. We have a very large database, larger than the other CCRC in the country, and we've done some unique things. I know that when California revised their regulations from the formula that was done for measuring reserves, they did send an RFP out for many actuaries to review the reports. Our firm was graded the highest, and so we reviewed many other studies that were there. But the rates were in existence beforehand, so you can't blame us for that. In fact, I'll say this now, and I'll say this later in our presentation, I would be just as happy if there were no CCRC financial regulation. And that may seem a little odd, but why did I say that? Well, for two reasons. 85% of our clients across the country, and we work with nearly 500 CCRCs nationally over the last 30 years, are in states where an actuarial study is not regulated. 85%. And what does that say to me? Or what should that say to you? Why are these folks hiring actuarial consultants to help them making their decisions? Well, what it says to me, and what I hope I can convey to you by the time we're done with this presentation, is that there is some value to using this tool with the appropriate assumptions to help you make better decisions. So it's not so much of being forced to do it, because what happens when someone's forced to do something, they don't really get the value out of it. It becomes a commodity. Oh, well, I've got to do this actuarial study every 5 years. It doesn't really matter what it says or what I should be doing. I'm doing it because I'm trying to meet the state requirement. Versus what many of our clients do is every year do the study, integrate it into their pricing decisions, use it to explain to residents why fees are going up 3% when the operating costs went up 4%, so we can have adequate reserves to meet those lifetime obligations. That's what this tool is really about. We have a bunch of software still on school. Let's talk about some of the issues that face you as a resident coming in. The question you should ask, and there are 10 of these. I'm going to go through all of them, each one. First one is life care viable? When I started this in 1979, the rumor was Type A contract. And let me just explain what Type A would be. That's a contract where a resident moves in, pays an upfront entry fee, and then pretty much pays the same monthly fee other than inflation adjustments for the rest of their lives. Back in 1980, I remember hearing folks saying Type A contracts are dinosaurs. Mind you, this industry was innovating managed care at that time. They were providing assisted living and nursing care for no additional charge. And even in the 90s, it was still a dinosaur. Today, it probably still is a dinosaur, but it's the best long-term care insurance policy anyone can buy, and it is thriving. Yes, there are other options, and that's really the key. Life is about options at all. I'll jump ahead here just 1 second. Life is about options. I'll come back to the slides in a minute. What is the best CCRC contract? Is it this Type A? Is it one that's more fee for service? Is there a rental contract? What is that magical crossover point there? To give you a perspective on the answer to that question, which is better, an adjustable rate mortgage or a fixed rate mortgage? How many think an adjustable rate is better?
Right now.
Yeah, depends, exactly. Depends on the economic conditions, depends on your risk utilities and so on. But the same thing with the CCRC contract. If you are concerned about depleting your financial resources, don't know whether or not you're going to need nursing care or assisted living a lot for a long-term period of time, if you have a spouse who you're worried about, Type A may be the way for you to go to ensure these benefits. Alternatively, you say, well, look, I'm going to take that risk. Everyone in my family's died of a heart attack, mountaineering at the age of 90. I'm not going to worry about the health care risk, so therefore I'll go for more fee-for-service, or I may go for a rental contract. Is there some magical crossover point that is a contract that everyone wants to purchase? Well, if that were the case, in my 30 years of searching for it, I would have hoped I would have found it, so I would be retired many times over on a private island. But no, there really isn't. And the key is the handout that Jack passed out a minute ago, really what's important, and the industry is not there yet, is giving residents choices on what contract they should choose and making sure that it's priced soundly so that no one contract is a better deal than the other contract for residents. Let me just go back here. Go back to the is it viable? Yes, life care is viable, and it can be priced and operated in a variety of ways. In fact, 2 years ago, the GM did a study, as well as the U.S. Accountability Office, to look at CCRC standards and structures. Really, this study was a repeat that was done about 25 years ago when there were a number of bankruptcies for bond financing of CCRCs. And if my memory serves me correctly, pretty much the same kind of things were said. You should have certain minimum reserves, cash reserves, etc. But at that time, they did not mention that you should have periodic actuarial studies. In my mind, this latest round, and it was not necessarily a push for national regulation, in fact, our regulation is on a statewide basis, still misses the point. What was the cause of this inquiry? Well, it was bankruptcies, or pending bankruptcies, on fee-for-service communities. And those are the ones that offered pretty much fully refundable entry fees and promised residents a monthly fee that increased by the level of care. The quote-unquote safe kind of way of offering a continuing care contract, because the health care risk and the fact that runaway health care was now passed on to the resident. Well, these so-called safe CCRC contracts are the ones where they ran problems because they were promising refunds based on the next generation, the real estate market was bad, etc. Nothing was done with these two national studies by our government to try to remedy that problem, and there is a way to do that, but that issue was not touched whatsoever. Again, these Type C contracts are still felt to be safe, even though the empirical evidence shows these are the ones that are having the problems nowadays, and I'll get more into that later. But the question becomes, and really when I mentioned about using actuarial science as a tool, the issue is quite simple. It really relates to some of the recent things you've heard about Social Security. As Jackie mentioned, Mr. Dyson mentioned about Social Security funding, and people may not understand, what do the actuaries really do? Well, here's what they do, what they try to do. Actuaries deal with assumptions, number one. They try to analyze data to make good assumptions about the future. But more importantly, there are certain actuarial models that are constructed that can tell the following. In the case of Social Security, when it started out, it was supposed to be actuarially funded. There would have been assumptions about how many workers to retirees are now and how many we project out in the future. Now, those assumptions may have been wrong, but for a certain set of assumptions, it would determine how much money should be collected in Social Security for a certain wage base at a certain tax rate. Well, in the wisdom of our government, we decided not to do that, and instead, we said, well, look, we'll go on a pay-as-you-go system, because we know, or hope, that if we have a change in the demographics, we can raise the wage base. We can raise the tax rate to make sure we have adequate funds to pay the Social Security benefits. And that's really the key of the issue, very much like the pension plan, and the same kind of demographic and mathematical economics operating in CCRC. Yes, you can run them on a pay-as-you-go basis. Yes, you will have great cash flows initially because you're collecting 30% of your costs on average up front via the entry fee. And so you basically put your community in the risk mode that as long as things stay the same, and so as long as the same kind of healthcare risk is in, you'll have adequate cash flows as long as you keep it full. But from a resident viewpoint, is that the safest way to protect my investment in a CCRC? I would suggest doing actuarial funding where you're making assumptions about what the future demographics are and therefore building up substantial reserves that are not profits, but basically are the difference between future costs of caring for your residents and the monthly fees they will pay. And that's really the basic trade-off. Neither one of them is a magic bullet and so forth. You can run it on pay-as-you-go, you can be lucky and it'll go forever and ever. It may take 40 years before you get to your tipping point like Social Security is, or you can do actuarial funding where you pretty much indemnify yourself from that kind of tipping point as long as your assumptions are regularly updated and you adjust them appropriately for any dramatic changes in your demographics. So the key for residents is to say, do I want to move into a community that is actuarially funded or one that's pay-as-you-go? And if I do pay-as-you-go, I recognize I do have some risk, even though I may have lower fees initially. Well, what is the best contract? And I jumped ahead of that. We've already asked that. There is no best. It just depends on your particular perspective and so forth. But one thing that people talk about when they say type A is a dinosaur is that, well, we're so concerned about the healthcare utilization, i.e. the assisted living and the nursing care, causing these contracts to be bankrupt. Maybe we should go fee for service where you now put that risk back on the residents. So they're the ones responsible for, quote unquote, insuring themselves. Having been a student of life care for 34 years, I have yet to find any CCRC in the country who has gone actuarially bankrupt because of runaway healthcare usage. They've all been very good stewards of managed care, so the actuarial issue of healthcare is not really what causes the problems here. Actually, it's number one. And then number two, which is a hidden risk that I think is going to become more and more, is the fact that people are living longer and longer and may deplete their financial resources. And virtually every CCRC in the country, when someone runs out of money, agrees to take care of them and not put them out and so forth. The PR issue is very strong. It's not a federal mandate. It's not IRS law. Although if one were to put someone out, even with good reason, you'd probably raise some pretty significant scrutiny when you're 501c3. My point here is that the longevity risk is probably the biggest risk that faces any type of entry fee or rental CCRC today. And if you want to minimize that risk, then your type A contract is the one that does that the best. But again, there's no perfect contract. People really want to have choices. How likely are residents to run out of their financial resources in the CCRC? Well, more likely than the general population. I'm sure y'all have heard the statement, and maybe some of you have moved in and heard this, if you move into my CCRC, you will live longer. Has anyone heard that before? Unfortunately, it's not true. At least not scientifically true. Yes, people do live longer in CCRCs. Their lifetimes are similar to people who purchase annuity policies from insurance companies. So the point is, it's a self-select group. People are willing to put up a large upfront sum of money, have generally had fairly good wealth and good health care along the way, and also probably want to feel that I want to make sure I get my money's worth from this CCRC. And also, you probably have a few residents say, well, wait a minute, I really don't like my executive director. I'm going to make sure I'm going to stay around as long as I can to make sure we're her have a hard time. But the point is, the yeah, absolutely. But the point is, the CCRC residents build long-term population. They like to do it. It's a self-selected group. So we're not denying that there's a certain ambiance and things like that involved. It's a great place to live and nice security, but they're already going to live long, and therefore the fact that having these contracts, the good food, the lifestyle center, one has to be concerned if you have moderate means whether or not you will deplete those resources. So that would be number one on my list if I were a resident, to be concerned that one, this community recognizes the fact they have a lifetime obligation to me and have the adequate reserves to make sure that they can cover that. And then number two, in choosing my contract, that I have sufficient financial resources to pay those fees over time, because no CCRC can retire you from inflation. That goes back to the days of Pacific Columns when they did their bankruptcy and so forth, and that contracts that pay a fixed amount up front and a fixed monthly fee. It just doesn't happen. You can't retire from inflation. This is from my database, and actually both males and females tend to live longer than the general population. Which leads to my next one. Can you retire from inflation? No. As much as we would like to, you're still in the real world of the CCRC. Their costs may or may not go up as much as the general inflation, but they're going to go up some because it's primarily a wage-based and a healthcare organization. From my data, looking in from 2010 to 2009, operating costs and income went up about 3%. Nursing, assisted living went stayed pretty constant over last year during a flat economy, and nursing care was up about 2%. The fact that the operating costs go up to maintain a financially viable CCRC means to some extent your fees are going to have to go up to match that. And in fact, monthly fees for our clients went up 2.5 to 4% over that same period. And entry fees went up to 0 to 3%. So you're not going to retire from inflation, so as you're planning to move in, you want to make sure that you have sufficient resources that are able to cover moderate increase in inflation. You don't have to have necessarily twice the monthly fee, twice the income of your monthly fee, but you want to make sure you have resources to cover that. And also you may need to understand, you might, if you live very long, have to go into your assets to continue to pay some of your costs. That's just a function of you being one of the people who live a long time. What are those reasonable expectations for inflation or the future fees? Well, they're hard to really specify, but as a general rule, we say to our clients, one should expect fees to go up to match your internal inflation each year, but not the CPI. And by that I mean, if your budget goes up 2% in your operating budget, then fees are probably going to need to go up 2% in that same year, even though you may have reserves that total $10 million or more. Because those reserves simply represent covering those future costs that are not covered by those monthly fees. And let me kind of put it in this perspective. We've done lots of studies and looked at lots of contracts. On average, the typical CCRC contract for our clients with an age 80-year-old, 80% female, 20% male resident, this is actuarial speak, but typical resident, costs $500,000 in present value. In other words, if this person had $500,000 in the bank, earned, say, 5% interest on that money, never paid a monthly or entry fee, those monies would be depleted by the time they expire if they live like a typical resident. And that may be 12 years, of which 3 years are in assisted living nursing care. And so that on average means that someone may live 5 years, it costs $250, someone may live 17 years, it costs $750. So the average is $500,000. Question to you: if we expect on average the contract costs $500,000, do you think that is fair or appropriate to charge say $450 for that contract on that combination of fee and monthly fee. You might charge $150 up front and then expect future monthly fees to get $300,000. How many think it's fair to charge less than that? Because everybody wants a good deal, right? You want to give your residents a good deal? All right. How many think they should at least charge that much to cover those costs? Well, he said they're absolutely all right. And in fact, we suggest that you might charge a little bit more to have a margin, because in calculating that $500,000, we had to make a lot of assumptions. Assumptions about longevity, assumptions about future care costs, assumptions about future interest earnings, etc. So you may want to have just a little bit of margin to protect yourself against those assumptions. Well, here's my point. If you price a contract that's worth $500,000, and let's say you collect $150 up front, you will have great cash flows, and you should accumulate substantial reserves. And so you can't get around that kind of situation, and so forth. And this is where this pay-as-you-go versus actuarial funding goes in. In pay-as-you-go, you'll have minimum reserves. When you do actuarial funding where you're collecting dollars up front, you're going to have pretty big reserves, which go to this slide right here. And let me try to explain this very carefully. Let's say we had 200 residents who cost us $500,000 each. That means their lifetime obligation is $100 million, if I did my math right. I used to do math in my head. I may have done a number wrong, so forgive me, but $100 million. Let's say that as an entry fee, you collect 30% of those costs up front, which actually is the average of what our clients do. So that would mean that $100 million, you collected $30 million. This implies that $70 million is going to be collected over the lifetime of those residents in there. So your reserves initially are going to be the difference between your $100 million lifetime cost and the $7 million monthly fees of $30 million. And your entry fees cover that $30 million, so you're in actual balance. Everyone following that concept? All right. Now, doing this calculation at $500,000, we assume inflation, or your internal inflation, is going to be 4%. We assume that you're going to earn 6% on your investments and so forth. What happens to 4% money in 18 years? Does it go up 50%? Does it double? Does it triple? Anyone want to venture a guess? It does. Okay. Well, let's take the same community in steady state, go out in 2017, 17 years, 18 years out. That $100 million liability for those same 200 folks, and they've been replaced by when they died, and now they got someone else out there. That same $200 million liability now has doubled just because of inflation. So now it is $200 million. And if we increase our monthly fees to match that internal inflation, monthly fees would double as well from $70 million to $140 million, which means our actuarially funded reserves should be $60 million. Now I ask you this question. Do you think you could have run your CCRC and paid all your bills and met your debt service if you'd only accumulated $10 million 18 years out? Yes, you could have, actually. On a cash flow basis, you could probably, because you got to remember that $30 million is not the cost of the incurred today, it's the cost of the remaining lifetime of your residence. So those costs have not run through the system yet. The point is, anywhere from really $0 to $6 million, you could have made a cash flow operating CCRC. The question becomes, what a resident should ask, and what the board who's charged with the fiduciary responsibility of running this community is, what was the appropriate level to operate and accumulate reserves? Going back to the slide about the $500,000, if you said that it was appropriate to charge $500,000 over the lifetime of the resident combination entry fee and monthly fee, then you're saying that you would accumulate reserves at $60 million. That's the implication of that policy. In other words, that you're doing actuarial funding. So when I talk about this concept to boards and resident groups across the country, no one says that we should charge less than what it's going to cost a resident over their expected lifetime. Then that leads you to the inescapable conclusion that you need to accumulate actuarially funded reserves, that you need to go beyond just simple cash flow management. And that's really the charts that we're suggesting here, that You look at the numbers, then decide for yourself what makes sense. But the fundamental issue is that if someone is telling you that your contract is going to cost $500,000, I have not yet heard a resident say they don't want to pay their fair share of their costs, nor have I had a board say they don't want to collect their fees to cover those appropriate costs. We may differ on the various assumptions of how to get there, but once we agree on those assumptions, those are what the costs need to be. And that's a very important implication, but also one of the reasons why financial management of the CCRC is so complicated. There are such tremendous cash flows on the entry fee CCRC that it becomes very confusing to say, was that $30 million profit? And lose sight of the fact that that $30 million was reserves associated with this initial entry fee. And going out 17, 18 years, now that 30 should be 60. Is that $60 million profit, or is it reserves that we should have? Does that concept make sense to folks? But it's a challenging one. And again, when we talk with residents groups, many boards ask somebody to talk with them, we try to sit down and try to explain the basic concept. Now, there's a lot of math involved, but the point is, if you're saying we want to pay out a fair share, if you collect the dollars up front, this consequence is inescapable. And this is a signal of a sound community back to the security, financial security for moving in, is that if it's being run well, it should have an accumulation of cash over time because of the reserve needs and so on. And one thing I should say, if you're operating a CCRC, in 100 years will these reserves go away? No, they don't. Because your contract is set up so that you're charging monthly fees less than the total cost, operating capital. So as long as that's the case, as long as you're replacing resident, those reserves are going to be ever increasing. Now, if inflation were constant for the next 70 years, that $60 million would stay at $60 million. But to the extent that there's going to be inflation involved, that $60 million will increase roughly to whatever that inflationary impact will be. Okay, we're running a little bit longer. I got a couple. Let me just go through one or two of these, and then we'll do some questions. And I will go through the slide. Refundable fees are pretty challenging. The issue is just simply depending on the next resident to reoccupy. It becomes a real risky source of repayment. Let me go to 8 here just for a second. Let's go to actuarial CCRCs. How actuarial CCRCs fare? In other words, does this work in the real world? Are CCRCs who adopt an actuarial approach to their pricing, are they financially viable? Can they stay full? Will residents move in? Number one, when we look at our clients, and as I said, we do over 125 studies a year, basically 80% of our clients are priced so that their reserves are actuarially sound. And in fact, even through the downturn from 2008, there was a dip in 2008, but basically their median reserve position has that slightly increased, so they've done better than many other facilities. And also, their fee increase, their fee margins for charging fees, they have over 10% margin in their fees as well. Most of the reserves are liquid, so it has worked out pretty well for them. In fact, those clients are the ones, even with those fees, and you may be afraid to be very high, are still over 90% full in option IRL and so forth. Let me just end up about financial regulation and does it really work? Couple things. The biggest challenge in regulation is that you cannot legislate full opposite. If you do that, then you will solve a lot of problems in a lot of ways. If occupancy goes down, and there are a lot of reasons why you actually go down, notwithstanding the current economic terms where people can't finance and sell their homes, then you're going to struggle because you're spreading your costs over a smaller base of residents, which means you may have to adjust fees. If you've been actually funded and has some contingencies built in, you probably can withstand these trends better than one that's just on a simple pay-as-you-go, very thin margin, which is another layer of risk. Yes, that does mean you may have paid more fees up front, but then, again, the question is, from a resident viewpoint, do you want to move into a facility that has a higher level of financial risk regarding future sustainability versus one that has a lower level of financial risk for future sustainability? When we look at entry fee contracts and regulations, they allow Type C to opt out, a big mistake, put everyone on the same footing. Type C contract that has an entry fee, has similar actuarial risk, and represents the same kind of concept, because those entry fees are not profit. No one is charging a Type C contract. It's a purely rental contract. That's what it's marketed as. In other words, your monthly fees are covering all your costs, but they really are not. They're not covering all the capital and operating costs. So therefore, that entry fee does lead to some kind of reserve and so forth. So they should be opted out, and they are not less risk. There is a challenge with gap interpretation, but the point is, what is important for a CCRC board of management is for the residents, the board, and the management to work together as a team and understand this contract has risk. Let's look at what our lifetime costs are and decide fundamentally, are we willing to run our facility on a pay-as-you-go basis and accept the risks that are associated with this sustainability versus moving to some type of actuarial funding basis, recognizing that there are lots of assumptions involved, and we need to make good decisions about those assumptions with the trade-off that's going to give us a greater level of financial risk. And then lastly, before we go to question and answer, we do have some concepts of how we might simplify this, but it's a complicated procedure. Let me just put it this way. We developed in our pilot testing a 7-factor scoring system to place communities to assess their financial risk for a prospective resident. So the community that has a lower financial risk based on these characteristics might be more attractive for residents to move in because they're concerned about their fiscal security and so forth. Doesn't mean that someone is a high-risk community that does pay-as-you-go, that is fee-as-you-service, residents will move in, but at least they would know the relative risk and the implications of moving into this facility, what it may entail. And I think that's a more viable way of financial regulation. There's obviously regulation for other parts in terms of licensure, et cetera, but just from the financial part in terms of saying you need to have an X amount of reserves or a certain dollar cash available, that's not really getting the point. The point is putting the concept out there, what is the appropriate risk associated with this facility, and if it is perceived to have too high risk by the marketplace, they will choose a less risky facility, or if the board of management feels that their financial risk is too high, they will take steps to minimize that risk by looking at their long-term financial position and adjusting fees and so forth. So at this point, let's go ahead and because we just have a few minutes left, any questions that we might have. Yes, sir.
You said there were 2 reasons. The main reasons for the bankruptcies were, one was people living longer than expected, and the second reason was?
No, the living longer is not a reason for bankruptcy. That's a risk that a resident faces in terms of running out of money. Primary reason for bankruptcy is a low occupancy because of real estate, and so they don't get filled up, so they can't meet the debt service and so forth. I've never seen a community go bankrupt because of runaway actuarial utilization of healthcare experience. So that you know, that's a fear of what's associated with a Type A contract. That risk has never manifested itself in an actual bankruptcy or a CCRC. There are other factors, bad management, et cetera, things like that, but it's primarily occupancy is a key issue and so forth. And nor have I seen any CCRC contract save a community. In other words, there's no perfect contract where if you offer that, that'll fill up the facility.
Yeah, I think that the assumption is that, you know, if there's a trusted provider, a religious organization or something, that everything's going to be safe. And it doesn't work out that way because you have to be so careful. It's so easy to be optimistic in the initial projections to start a CCRC. Oh, we need this facility for our parishioners or for some group. And then over time, you say we're doing this wonderful service. Over time, conditions change. And if they change just as you bring product on the market, then you're going to have trouble with fill-up. So we have a lot of communities now that are running at 60% in independent living. Assisted living and skilled nursing seems to be selling itself because people fail and the demographics are growing, so that's keeping them going a little bit. But to make this an attractive thing is a much more difficult problem. I think this would be best if this were in the form of a dialogue. Tim, do you have any thoughts on the accounting issues? Because I sort of challenged you folks. And the National Continuing Care Residents Association did submit a letter to FASB. They're now re-examining the rules of practice, but that's an area that might need some work.
Well, again, as from the accounting standpoint,
Who is speaking?
my name is Tim Evans, and I'm the moderator. I'm also a CPA, and with a lot of audit experience. To answer Jack's question, what the accounting standards are doing is they're constantly in a state of flux. They're constantly re-estimating how much or how these costs should be calculated. From an auditor perspective, what we look at is what the actuarials have done and the calculations they've done, and is there a overall potential deficit in their long-term calculations? If there are, that CCRC is in very difficult position. I haven't experienced any of our clients that have been in that position, thank goodness. Yet it's something that is a deep underlying concern for all CCRCs, and that worry that your facility will be aging and you'll need to use some of these reserves to refurbish your facility and be able to compete with all the other facilities that are upgrading. So it's a constant battle, and it's something that we as auditors look at regularly.
Tim, I wonder if you want to say a word. The Financial Accounting Standards Board has been criticized by the international accounting community because some of the American rules that are involved in American GAAP are inconsistent with international standards and principles. I wonder if you wanted to say a word about that, because I think that's an important step that's going on that's beginning to, I know Mary Miller, who's, I see, I'm Mary, she's already beginning to conform the accounting that she does to some of the new rules that have been, I guess, exposed at this point. But maybe that's something that some people may not be aware of.
Right. Well, for the situation of lack of time, just to go into, there are a lot of differences in international standards. The fear is that if international standards were to be implemented, what effect would that be on your financial statements for your CCRCs? And the answer is we don't know that until such time as those standards come out. But as we monitor these changes in IFRS, which is the International Financial Accounting Standards, if that comes into play, then we as auditors need to be looking at each situation and see if there is a potential change that could change your future service obligation and make it into a negative. Any other questions for Amy or Jackie?
Thank you all very much. Oh,
Amy, can I ask you what the percentage of IL residents that move into nursing skill, what do you see statistically over time that eventually end up in the nursing facility?
The question is, like, one way to say, what's the likelihood of a resident moving into nursing care? If you take away temporary transfers, which are short-term, say, probably about 1 in 4 are likely to move at some point in time. Another way to look at it, and we're talking about averages, I don't know, our typical age 80-year-old female has a life expectancy of about 10 years. We expect about 25% of that time to be in assisted living for our nursing care. So what that means is that, again, that's an average. So if you have 100 residents, you may have, some people have no usage whatsoever, and then another half could have actually 5-year usage. But about 25%. And that, one of the things that when we talk about, I haven't seen any CCRC with runaway actuarial experience in terms of healthcare, is that while it's a fear, everything we're doing, everything I read about extending lifetimes is not about extending assisted living or nursing care lifetimes. It's about extending healthy, active lifetime. So if anything, I would expect that percentage to drop in the future which means that the healthcare risk is not going to increase for CCRCs. It's the longevity risk, and that goes back to running out of money and so forth. Thank y'all.